Good morning and thanks so much for tuning in. You're watching Trade Talk on BQ Prime. My name is Mathew and with me is Hiral Dadia. Morning, Hiral.
Good morning, Alex. I think it's a day where we need to actually focus on the money markets, taking into consideration that the US bond yields have actually hit a 5% number. Now, with this, the kind of impact it could have on the Indian bond yields is going to be interesting to watch out for, and
Certainly.
that's going to be the focus for today.
Absolutely. You couldn't have said it better. 5% is a number that the 10-year Treasury hit not too long back. And in fact, it has come off since then. But the move upwards has been very substantial. That is reflective here already in the yields in the Indian bond market as well. The 10-year bond yield, the benchmark bond yield, has already hit the 7.37% mark. It has been very volatile of late, and it has actually moved from a range of 7.1% on the downside in the recent past all the way up to above 7.35%.
Absolutely. And when you talk to a lot of, bond managers as well, now they are of the opinion that if the US bond yield is crossed 5%, the 10-year yields, and if they sustain above this, don't be surprised if we are above a 7.5 or a 7.55% kind of a number in the Indian markets. And that is something which is going to then come and hit the corporates as well, with the borrowing costs that would be going up eventually.
Certainly. It's also important to take stock of what is happening in the US and why these bond yields are heading higher. In fact, over the last few weeks, you've had several members of the Federal Reserve comment about the fact that policy measures that will be taken from this point on will be taken on the basis of how these bond yields have also moved. In fact, to get us some more perspective as to why these yields are moving up and have been moving up, we're joined by Dr. Richard Harris, who's the Chief Executive at Port Shelter Investment Management. Richard, thanks so much for joining us this morning. Let's talk about the latest reasons why we heard Fed Chair Powell speak overnight. There's also the war, and some people are talking about a war premium building in. What are you reading in this situation?
Well, I certainly think there's a lot of stress built into these markets. And the markets have actually taken it on board quite well. You know, if you think we've had Ukraine and then we've had Israel, these are geopolitical issues of the like that we haven't really seen for decades almost. So, yes, there's no doubt about the seriousness of that situation. But at the end of the day, the old phrase comes through, it's the economy stupid. And at the end of the day, we're really looking at what are the economies doing? Are global indicators likely to be severely damaged? And typically they haven't really been. And as a result, the markets have been quite robust.
Right. So, Richard, overall, usually as a trend, what we've seen is that there have been times where in crisis, when geopolitical tensions are on, you have seen US treasuries which are taken as a safe haven. This time around does not seem to be the situation. What's your read and where from here on?
Well, we have seen quite a move in global assets in terms of, what is a haven, what isn't. Gold has hardly moved. Oil does seem to move, but on a much more short-term, high-frequency basis. Yes, U.S. Treasuries haven't moved, but I think U.S. Treasuries are becoming increasingly driven by what's happening in the U.S. and the U.S. economy. The time has gone when other nations wanted to park large amounts of cash in U.S. Treasury and in Treasury bonds. Many of them, like China, are already out. Many of them need that money now to support their own economies. So the US Treasury market, I think, is becoming less an indicator of global risk and more an indicator of US risk and exactly what's happening in the market there. And as we've seen, Powell seems confident enough that the economy is going to keep on moving, such that he's reserving the right to continue to increase interest rates.
That's interesting. And I have a couple of questions here, therefore, Richard, based on what you've just said. What is your base case assumption on what happens on the rates? Because what I read from his statement yesterday was that the next policy, they're not likely to hike. So there's a pause in at the end of this month. We're likely to see, and based on what the bets are building in the system as well, we're talking about a possible hike in January. So what, according to you, is the base case right now on policy rates, and what you said about the buying of US Treasuries. What happens with the US 10-year Treasury at 5% and the other yields also elevated? What happens to capital flows?
Well, my map looking ahead is that we're not going to see much more of a rise in interest rates. I think that eventually the slowdown of the economy will come through. But as we've seen, the economies have been quite robust, and we're still talking about maybe putting interest rates up. But I think we're nearing the end of that cycle. There's a lot of talk about 5% treasuries, 10-year treasuries today, but let's face it, it's just a figure, it's part of a continuum. I wouldn't be surprised to see them continue to go up, but probably maybe not go up as much as they are likely to, because of course interest rates are likely to wane if we do get a slowdown in the economy. So eventually that's likely to happen. We put interest rates up to slow down economies so that inflation starts coming off. So, that's the whole process. So we shouldn't be surprised. I think what surprised people is the strength of the US economy. It means that power is still in the market for interest rate rises, but I think they will be muted, and we'll probably see the end of them towards the early part of next year.
Right. Richard, how big is this demand-supply mismatch a factor in terms of impacting the yield so far? Because clearly you've seen the foreign ownership as well, which has been falling. In case the demand comes back, how do you see the entire gamut play out? Do you think Fed will actually have to come in and play a balancing role here as well?
I don't think that they're going to be that active. I mean, if you look at how economies work over the long term, we have a period often when interest rates go up, so we end up having an inverted yield curve, and everybody throws their hands up in the air and worries about recession. And then when recession comes along, we have a very positive yield curve. Well, the yield curve looks as if it's likely to turn quite strongly positive. Now, but over the next year. And that actually is an indication that the economy is likely to recover. So at the moment, we've had indications, we're going to go into recession. It hasn't happened yet because it doesn't happen immediately. It's all lagged. And then I think what we'll see is a strongly positive interest rate curve shape that will encourage economies to come out of recession. That's just what happens in the market. I think that what's happening is the narrative has gone way, way ahead of what the economies are actually doing. So we've got a recession narrative out at the moment, when in fact the economies are still working through the liquidity surges of the last few years. So I don't doubt that we'll have a slowdown looking ahead, but I think it's going to be held off for now.
It's interesting that you say that, because as I look at the last couple of years, Richard, we've been wrong with a lot of our projections, with a lot of the crystal ball gazing, if you can call it that we've been doing. We expected there to be a recession as things stand right now, perhaps when we were speaking about a year and a half back. What if we're wrong about this as well? Higher for longer seems to be what a lot of people are focusing on right now.
Well, you may be wrong, but I could not possibly comment. No, I think, of course, part of the joys of being in the investment markets is you try and make forecasts. You can't make predictions, but you try and make forecasts looking slightly into the future based on what the facts have happened in the past. And, as they say, this time it's different, or perhaps history repeats itself. That's the joys of the market. I think you just have to look at the evidence as it is at the moment. Yes, the markets are showing signs of fragility, but they need a trigger, some kind of major trigger factor to make markets go off. We saw the subprime in the US. We've seen other trigger factors more recently, like COVID, but they haven't been quite as serious. So we need a trigger factor. Ukraine hasn't been it. Israel so far hasn't been it. So that's one of the reasons why I think we need to build into a state of fragility such that the markets really do fall off. And I don't see that happening in the next quarter or so.
Right. So, Richard, with all of this, the way the yields are moving, what Fed could come and do, the comments that we've already heard, what's the kind of impact that you're seeing on the dollar index? Because that will help us understand a lot in terms of the impact it could have on the emerging markets as well.
Well, the dollar continues to be a safe haven, I think, and continues to spike up whenever we have geopolitical risk. It is even more high frequency than oil in that sort of sense. And I suspect it will be higher for longer. When people can put their money in the bank and earn 5% on it, that's pretty nice. At the end of every quarter, you've got a reasonable return. That's something that, should we say, younger investors have never experienced. And we have to remember that there's a big part of the investing community out there that wants yield, that relies on relatively safer returns. So it's not all bad news as we go out of there. And clearly, while we've got these interest rate differentials, there's going to be an attraction of money into the dollar just to pick up those yields.
Last question, Richard, and thanks so much for taking the time. But we're wondering what happens to emerging markets as we look at bond yields in the US hitting 5%, right? And I kind of asked you about what you expect will happen with capital flows, but how should emerging markets look at this situation?
Well, it's a topsy-turvy world at the moment. Normally you'd expect with such a bear market in bonds that equities to come off, and they haven't. We would expect gold to go up in times of crisis. It hasn't. So it is a bit of a topsy-turvy move. But I think the emerging markets are still highly dependent on what happens in the rest of the world. Yes, you may have some differentials. I mean, India, of course, has greatly exceeded China's performance in the stock market. Partly, I think, because there's been quite a lot of investment there in recent years, outsourcing, this kind of thing, the kind of things that India does quite well. So I think that really emerging markets, and let's face it, India's 120 odd years old, so it's not exactly emerging. But I think that these markets, which are so dependent on how the Western economy goes, they will still be following the Western economies and still have the same kind of sentiment attached to it.
Richard, so I think, Locks, we'll have to look forward to and see whether the things play out as per what we've been discussing as well. And if not, I think that's going to be a conversation we will have to revisit as well. Thank you so much for joining us on the show and sharing your views as well. And look forward to speaking to you soon again. So clearly, no one's actually, Alex, been able to clearly tell us what's the kind of direction we are expected to take from here. I mean, there is that dichotomy that still exists.
No, certainly. And, it's been pointed out in the last couple of weeks. In fact, there have been so many contradictory signals just in the last couple of weeks. On the one hand, you have jobs data that has been relatively resilient. You have retail sales in the US that has been relatively resilient. On the other hand, you have crude oil prices that are being watched very closely for the inflation signaling that comes in. So just in the US, there are so many multiple moving parts that will have a bearing on the Fed decision. Obviously, this one is taken for granted at the end of the month, but then what happens next month? What happens in January?
And the impact it could have with regards to emerging markets. And if you talk about India specific as well, is going to be interesting. And if you see from the corporate markets, what happens to the borrowers, right? In fact, we have Lakshmi Iyer from Kotak AMC joining in as well. Lakshmi, good morning, and thank you very much for making time this early in the morning. What do you make of this? I mean, we've had the US Treasury yields, which have hit the 5% mark already. Lots brewing. Firstly, an impact in terms of Indian markets.
So, the yields remaining, or the interest rates remaining for higher for longer, is the broad narrative which is spooking the global bond market, specifically the US. That's number one. And so long as the US bond yields don't stabilize, it's going to be very difficult to see the Indian markets, both the capital markets as well as the bond markets, stabilize. Because if you see Powell's statement, Mr. Powell has spoken about the persistingly high inflation and therefore its impact on lowering the economic growth. But clearly the future guidance in terms of how higher can rates go, I think that factor was already missing. So I think all of these is kind of compounding to the uncertainty. And I think we need to see US yields stabilize before the Indian markets actually, gain some calm.
Let's talk about the 10-year benchmark. Lakshmi, good morning as well from my side, and thank you so much for taking the time. We've seen it move up very sharply to that 7.37 odd level. This is all over the last few weeks. We've been talking about things like the inclusion into the global bond index that has had a bearing on the Indian bonds. But then the latest, of course, seems to be the spike in US treasuries. Where do we go from here, and how do you see the yield curve developing?
So the bond yields already are acting, I would say, northward in response to two factors. One is obviously the US Treasury yields heading upward. And second, more importantly, is the expectation of the impending open market bond sales by RBI. So I think these are the two factors which still continue to be in the uncertain region. However, at around the 5-ish levels on the US Treasury, we think that the rates are kind of peaking out because the US housing data is at a 13-14-year low. And that is one of the clear barometers of the health of the US economy. So I think they're about 5-7 basis points. So I think US Indian yields could probably inch closer to the 7.45 region or thereabouts, and then just kind of stabilize there as US yields keep gyrating. So it's very important for US yields to hold on for some time now.
Right. So, when you talk about the 7.4, 7.45 kind of a trajectory, Lakshmi, what's the kind of timeline you're looking at? And say towards the end of the financial year, where do you see it actually settling at? Because I'm sure this will not become the new normal as well.
No, see, India, I think our inflation numbers are visibly better. Even the next month data is portending to be a bit lower. So I think all that points to the fact that these are the near-term, I would say, speed breakers to the bond yields. We also need to keep in mind that going into June 2024, we are going to see the index inclusion on the Indian bonds. And I think towards financial year 2024, that is, as we end this financial year, looks like the bond yields could be lower than where we are today. So I think we are on whether global bond yields on the US side or on the India side, looks like we are trading on the right. If you have a left-hand band and a right-hand band, we seem to be heading or trading towards the rightmost band, where the incremental pain points from here seem to be lower.
Lakshmi, we don't often talk about strategy in bonds, and we generally take a longer term approach to investing, particularly through bond funds, etc. But then if you were to talk about strategy from this point on, and if you're talking about how fund managers will likely approach this, would you say that it's a buy? Indian bonds are a buy on the longer end? And you also have, by the way, one of your peers that has started a fund of funds that invests in US treasuries. What do you think about that strategy?
No, definitely. If you look at it from an Indian investor standpoint, closer to 7.5 to 7.5%, there is a case to add some duration closer to the 10-year bucket. So within the 5 to 10-year bucket, there is a sweet spot. But clearly, I must tell you that for the foreign investors, given the gap is so narrow, there is still a merit in looking at the US bonds at the current juncture, given the elevated or the inverted nature there. Also, the up to 3-year, 4-year segment in the US, the sovereign US yields are looking lucrative, even from an Indian investor standpoint, to take some positions as we speak right now.
So, Lakshmi, a question that I want to take with you from an India perspective now is, when does the RBI actually come in with their bond buying program? What could be the potential timings according to you?
Well, I think bond buying seems to be out of the window for now. Looking at the liquidity, markets will actually speculate if there could be bond sales, which is supply of more bonds, in the market. Which is already reeling under week-on-week auction. So I think markets are still sort of doing a wager on some kind of an OMO sales in the month of November. Though there is nothing explicitly stated, but clearly the bets are still not off. So I think that will keep continuing to unnerve the markets for now.
I'm just wondering. So you're talking about how the RBI is likely to intervene, but with yields where they are right now, I'm just wondering about the second half for the government's borrowing program. What kind of implications do you think, Lakshmi, that will have? Is there enough demand for that kind of borrowing that will take place?
Well, the credit growth in the banking system is not, very, very esoteric compared to what we saw, say, in the last financial year. It's continuing to keep pace. Rates are elevated, so the fixed deposit or the deposit mobilization is also happening. So I think from a demand perspective, we don't really need to worry too much. Also, as I mentioned, June 2024, the foreign portfolio investors may actually start positioning into Indian bond markets at the start of the new year, which is the calendar year 2024. So I think all those will act as demand levers. And also, we must not forget, with yields rising upward, the terminal benefit funds, the pension funds, provident funds, they would love to lock into their yields, expectation of rate cuts, with a lag of 3 to 4 quarters. So I think all that suggests that there's no reason to feel extremely disturbed about the demand scenario. I think the demand supply with pockets of anomaly should look to match.
Absolutely. I think so. Lots brewing here, lots to watch out for as well. Thank you, Lakshmi, so much for joining us on the show and making the time a good set of information for the viewers as well from here on, and takeaways that we will be going with. So that's the overall discussion that we're having with regards to US bond yields hitting that 5% mark, the kind of impact it could have on the Indian market, bond market as well. We will continue this discussion on the throughout the day as well. Various shows, various guests. So you can absolutely log into BQ Prime to discuss, to hear more on this. But moving on to the equity market. Overall, Alex, yes, there has been negativity. That's what Gift Nifty has been indicating so far. So the opening is going to be crucial to see where we open at, because 19,500 was the level we are watching out for. A break below that could be probably something on the negative side.
Absolutely. But if we saw what we saw yesterday, and there was considerable selling in the global markets yesterday as well. There was resilience. We saw the benchmark Nifty 50 end with cuts of just about 0.33%. And you saw the broader markets, in fact, that were even more resilient. So the small cap 250 index ending, in fact, with gains of about 0.1%. So it wasn't too bad. We'll have to see if that turns out.
And plus, you have two majors, ITC and HUL, that have reported numbers, right, post-market as. So their reaction is going to be interesting. But before that, a lot of other broader market earnings that have come in. Saloni is standing by to get us more in terms of which are the names that she's been tracking.
Right. So there are some companies that should see a positive movement in trade today on back of good earnings. So that includes Jindal Stainless, Hudson Agro Product, Havells, and Voltas. So starting with Jindal Stainless, so the top line saw a rise of almost 12%, and the bottom line saw a 2.2 times growth. So the sales volume was up 26% on a year-on-year basis as the domestic demand for stainless steel continues to rise. And ahead of the upcoming festival season, the auto segment, besides other consumer-facing segments, witnessed an uptick. Next, we have Havells. So the growth in revenue is attributable to the company's switchgears and cable segments. The switchgear growth was driven by infrastructure and construction, and the power cable growth was aided by infrastructure projects. There was margin expansion across all segments during the quarter. The cable margins reverted to its normative level post-commodity price-led disruption in Q2 last year. Next, we have Voltas. So the revenue growth is led by the 370 crore rise in the electromechanical projects and services segments of the company. The fall in EBITDA was due to the rise in expenses by over 560 crores. Then Hudson Agro Product. So the revenue growth was around 9%, while the net profit was up over 80%. The margins also saw a slight rise of 1.3%. Then there are a few other companies that posted their results that saw a decline in either their top line or bottom line, or both. So the first one is Kirloskar Pneumatics. So the company saw a decline in its top line as well as its bottom line. The compression segment revenue of the company declined by 7.5%. And since more than 90% of the company's revenue is generated through this segment, it affected the top line numbers. The next one is Sagar Cement. So the revenue was up 24% and margins expanded significantly. This was on account of a weak base last year that was impacted by high fuel cost inventory and low utilization levels. Then Tata Coffee, the revenue fell 3%, but the net profit was down 57%. And this was primarily on account of the exceptional gain of 137 crores in Q2 last year. Next is Tata Communications. So the revenue was up 2.11%, but the sequential growth in profits was subdued on account of a one-off increase in other income in the June quarter. Then Ganesh Housing Court, so the revenue fell by 50%, but the expenses fell even further by 82%. That drove margins. The net profit was further aided by lower tax expenses. And lastly, United Breweries. So the revenue was up 14% and the net profit dropped by 20%. So the increase in net sales was fueled by volume growth and strong pricing. The gross margins declined by 210 basis points on a year-on-year basis, whereas it grew by 400 basis points on a quarter-on-quarter basis, which was led by cool-off in inflationary pressures and price hikes. So the management said that they remain optimistic on the long-term growth potential of the industry, which was driven by increasing disposable income, favorable demographics, and premiumization.
Premiumization. Thank you so much for joining in and giving us all of those details. By the way, in case you missed any of what Saloni said, there's a very detailed story on the website bqprime.com that will fill you in on all of the companies that she just spoke about. Let's shift to one of the larger cap peers of the companies that we just discussed, and that's Ultratech Cement. We're discussing the review of the second quarter earnings. We're joined by Rishi to give you some perspective. Rishi, good morning.
Good morning. So overall, a really good set of numbers in line with expectations. In fact, profit grew by about 69%. Then volumes, they rose by 15% and they majorly drove the revenue growth. Now, this is on account of capacity additions as well as strong domestic demand on account of this being a pre-election year. Now, margin expansion was primarily driven by lower fuel costs. Now, realizations were more or less flat, so that didn't contribute much. But energy costs, they fell by 10% and they accounted for about 35% of the overall cost in the second quarter. And based on management commentary, the management is targeting to complete its phase 2 expansion to increase its overall capacity to 160 million tons by June 2025. And over the longer term, it is targeting a 200 million ton expansion by the end of the decade. Now, it also indicated that the higher price scenario with regards to cement right now in India is likely to hold, given that input prices are rising. And for the company specifically, the cost curve is moving southwards. So the expectation is that the margins will improve, and that's what various analysts are also pointing out. So HSBC has in fact increased its target price to 9,300 from 9,100 that was there earlier. And again, analysts are focusing on the margin expansion as well as Ultratech's outperformance with regards to rest of the industry. Then there's CLSA, which has upgraded the stock to outperform from an underperform, and the target price has been increased to 9,450 from 8,400. So really big upgrade. And again, the reasons for the same are margin uptake and outperformance with respect to the industry.
Right. Thanks for getting us the details. There's a lot of consolidation that is on the cards as well in terms of the cement space. So our eyes will be on this. And you have the elections coming up. So construction activity will pick up. Prices have been on the increase as well, apparently, with the markets are absorbing, it seems, so far. Thank you, Rishi, for getting us the details. But moving on, a lot of other stocks that are in focus apart from earnings. And the focus was initially that Zomato could be the big one as well in terms of the block deal that was expected. Mika is standing by to get us more in terms of few of the order wins, what was brewing with Zomato et al.
So first, let's start off with Zomato. The block deal has already taken place. As per the term sheet, SCF Growth sold around 1.1% stake. It offered 93.6 million shares in the block at a floor price of 109.4 to 111.65 rupees, and it seeked up to $123 million via the stake sale. Next, we have two order wins. First is RVNL joint venture, which got a 174.27 crore contract from Vadodara division of Western Railway for civil engineering works in Gujarat, and the project is expected to be executed in the next 24 months. Then we have Tejas Network, which received an order worth 107.73 crores from TCS to supply equipment for BSNL's pan-India 4G and 5G networks. Then we have Gulf Oil Lubricants, which entered a strategic collaboration with S-Oil 7 in order to expand its business in India. Gulf Oil will oversee production, distribution, promotion of OEM networks like Kia India, and the product line lineup will feature a variety of passenger car, gasoline, and diesel engine oil variants. Gulf Oil is also going to have exclusive rights to manufacture and distribute S-Oil 7 range throughout the network. Then we have PTC India. The board approved the sale of its unit PTC Energy, and it will divest 100% stake in the company. And the buyer is ONGC, and the sale consideration for the sale is 925 crores. And lastly, we have Grasim Industries. The company got a 141 crore demand notice from the Rajasthan stamp collector. The demand notice was based on alleged non-payment of stamp duty on a scheme of arrangement between Indian Rayon and the company from financial year 1999, and the company is taking all the necessary legal steps to do the same.
Okay, all right. So thanks so much, Mika, for bringing us those updates. We've got JSW to look forward to as well. And in fact, the results will be out later today. Of course, the estimates from Bloomberg suggest that the revenue will rise as much as 3.2% or 3.4% to about 42,500 crore rupees. And we're expecting a net profit of about 2,419 crore rupees, as opposed to a loss in the comparable quarter of about 848 crore rupees. Remember, volumes were up as much as 13% year on year to 6.41 million tons. But you have to watch out for weaker realizations that will be offset, of course, by lower costs. There were also lower coking coal prices, which will aid margins in the quarter gone by. And finally, the management commentary on steel prices will be watched very closely. Input costs, of course, remains a very key watchable.
Absolutely. And the numbers are speaking, really, I mean, if they are able to meet this, I think a positive move in terms of the stock price could be warranted as well. But clearly, Alex, from a market's perspective, with all that we've spoken, you have Brent, which is above 92, the dollar index, which has inched above 106, US Treasury yields, which have gone beyond the 5% mark. All of this will give you high amount of resistance at higher levels in terms of equity markets as well. So in spite of Indian markets being resilient, that resistance factor is going to come in. So that's going to be an interesting one to watch out for. In fact, the markets have already opened in terms of the pre-open. So let's just quickly figure out where we settle in from here on, and you'll get all the updates on BQ Prime. Please stay tuned.